There is a moment, quiet, unremarkable, when a person walks into a bank, hands over their savings, and walks out feeling responsible. Financially mature. Like they did the right thing. And in that moment, without a single word of deception, without a single fraudulent transaction, the most elegant wealth transfer mechanism in the history of American finance has just been set in motion. The money changes hands. The relationship begins. And the terms of that relationship are almost never what the depositor believes them to be. Here is the economic reality underneath that handshake. You are not a customer in that transaction. You are a capital provider. You are the funding source. You are, in every structural sense that matters, the landlord. And the bank is your commercial tenant, operating your asset, generating returns from your asset, and paying you a fraction of those returns while retaining the spread. The national average savings account rate in 2025 sits at 0.41% annually, according to FDIC national rate data. The bank deploys that same dollar into lending relationships, generating between 6.8% on a 30-year mortgage and 20.78% on a credit card balance, per Federal Reserve G.19 data and Freddie Mac's primary mortgage market survey. You are the landlord. You are being paid like a tenant. And the tenant just reported $49.5 billion in net income for 2024. That figure belongs to J.P. Morgan Chase. It is not revenue. It is net income. Profit after every expense, every salary, every data center, every regulatory fine. $49.5 billion. Wells Fargo reported $19.7 billion. These are not aberrations. They are the predictable, quarterly output of a system operating exactly as designed. And understanding the precise architecture of that system, not the surface layer, but the complete mechanical structure underneath, is what separates the depositor who feels optimized from the depositor who actually is. Let us begin with something the Federal Reserve disclosed in March of 2020 that received almost no consumer financial media coverage despite being one of the most consequential structural changes to American banking in modern history. On March 15, 2020, the Federal Reserve Board eliminated reserve requirements for all depository institutions. To zero. Not reduced. Eliminated. The reserve requirement, the fraction of deposits a bank was historically required to hold back before lending, no longer exists as a binding constraint. Banks had operated under a 10% reserve requirement for decades. That architecture, whatever its limitations, imposed at least a theoretical ceiling on deposit leverage. That ceiling is now gone. The legal constraint on how aggressively a bank can deploy your deposited dollar into interest-generating lending relationships was removed 4 years ago. Most depositors have never heard this fact stated plainly. The mechanism that captures the output of this deployment is called the net interest margin. The FDIC quarterly banking profile tracks this metric across all U.S. commercial banks as its primary measure of system-wide profitability. The net interest margin is the spread, the mathematical distance, between what banks earn on their lending and securities portfolios and what they pay their depositors. As of the fourth quarter of 2024, the average net interest margin across U.S. commercial banks stands at 3.39%, the highest level recorded since 2019, per FDIC quarterly banking profile data. Read those exact words carefully. 3.39% is the average spread the banking system extracts between your deposit rate and its asset yield. On a $30,000 deposit at the national average savings rate, that spread costs you approximately $1,017 annually in foregone yield. Compounded over 5 years, that figure reaches $1,593 of non-recoverable capital, paid not through any fee, not through any visible charge, but through the quiet mathematics of a rate differential you were never shown on a single disclosure document. Now follow this revenue cascade carefully, because the net interest margin is only the first layer. On the left side of this architecture sits the depositor, receiving 0.41% on savings, 4.5% on a high-yield account if they found one of the better promotional rates currently available. On the right side sits the bank's lending portfolio: credit cards at 20.78%, personal loans at 12.35%, auto loans at 7.5%, 30-year mortgages at 6.8%. Notice this massive gap between the left side and the right. That gap is not an accident. It is the designed output of a system that intermediates between capital providers and capital users and retains the spread as its primary profit mechanism. But the lending cascade is not the complete picture. Layered on top of the net interest margin sits a parallel extraction architecture that operates entirely separately. U.S. banks collected $12.1 billion in overdraft and non-sufficient funds fees in a single year, per the Consumer Financial Protection Bureau's 2024 Banking Fee Report. J.P. Morgan Chase alone reported over $1 billion in overdraft fee revenue in 2024. Beyond fees, banks operate payment float, the brief period between when funds leave one account and arrive in another, during which the bank earns interest on money it does not own. They monetize anonymized consumer behavioral data. They capture interchange revenue on every debit card transaction processed through their network. Your deposited dollar simultaneously funds the lending profit machine, the fee extraction machine, and the data monetization architecture. You are not merely a customer. You are the raw material. This brings us to the insight at the center of this analysis, the one the banking industry has a structural incentive to ensure you never encounter. Here is the question that changes everything. Inside this specific box of financial behavior, what exactly is the bank doing between your deposit and a U.S. Treasury security? The answer is this: a substantial portion of U.S. bank assets, held in their securities portfolios, is invested directly in U.S. Treasury bills and government-backed securities. The bank collects deposits, buys Treasury instruments, earns the Treasury yield, pays depositors a fraction of that yield, and retains the spread. That process, in the savings to short-term Treasury segment of banking, is a function any individual investor can execute themselves. Directly. Without the intermediary. Without paying the spread. TreasuryDirect.gov is a direct portal operated by the U.S. Department of the Treasury that allows any American with a Social Security number and a bank account to purchase Treasury bills at auction, receiving the full government yield with no intermediary markup, no management fee, and no institutional spread extraction. This option has existed for decades. The bank's entire business model in this segment depends on the depositor never asking one question: can I do this myself? The answer has always been yes. Now here is where the high-yield savings account enters this framework, because the HYSA is the financial industry's answer to the depositor who started asking questions. And it is a precise, calibrated answer designed to resolve just enough of the question to prevent the next one from forming. A high-yield savings account paying 4.5% feels like the final optimization. It feels like sophistication. It feels like the complete answer. But track the mechanics underneath. First, that 4.5% rate is not contractual. It is not fixed. It is set at the bank's sole discretion and can be adjusted without meaningful advance notice beyond what the account agreement discloses in its fine print. The Federal Reserve's rate cycle transmits directly into savings account rates, and that transmission moves both directions. The advertised rate at account opening may bear no mathematical relationship to the effective rate earned across a 12-month holding period. Second, and this is the tax asymmetry that almost no savings product comparison ever calculates, high-yield savings account interest is taxed as ordinary income at the federal level, the state level, and the local level simultaneously. Every dollar of HYSA interest is fully exposed to the complete tax stack. Compare that to what 31 U.S.C. Section 3124 codifies as a permanent feature of Treasury interest income. Treasury interest, whether earned through direct T-bill purchase, a Treasury ETF, or a Treasury-only money market fund, is fully exempt from state and local income taxes by federal statute. This is not a loophole. This is not a strategy. This is a legally established structural advantage of Treasury instruments over savings deposits that the banking industry has no incentive to calculate for you. In California, where the top marginal state income tax rate reaches 13.3%, or New York, where combined state and city tax exposure reaches approximately 12.7% for upper bracket earners, the after-tax yield comparison between a high-yield savings account and a Treasury instrument inverts entirely. A high-yield savings account at 4.5% in California yields approximately 3.26% after federal and state tax for a mid-bracket earner. A Treasury ETF at 4.1% yields approximately 3.02% after federal tax alone, with zero state tax applied. The advantage that appeared obvious at the gross rate level collapses when the complete tax architecture is applied. In high-tax states, the HYSA advantage frequently disappears entirely. This calculation is almost never shown in a consumer savings product comparison. It is being shown here, now, with sourced rate data, because this is the layer of the system the banking industry has a mathematical incentive to leave invisible. The complete alternative landscape currently available to a retail investor is more accessible than at any point in history. Phase 1 of the implementation framework begins with Treasury ETFs. iShares SGOV, the iShares 0 to 3 month Treasury bond ETF, holds exclusively short-duration Treasury bills, carries an expense ratio of 0.09% annually, settles on a T+1 basis meaning your funds are accessible the following business day after a sell order, and currently carries a 30-day SEC yield sourced directly to BlackRock fund data. Moving down to the second layer of the alternative landscape, Treasury-only money market funds. Fidelity's FDLXX and Vanguard's VUSXX hold exclusively Treasury securities and repurchase agreements backed by Treasuries, providing next-day liquidity comparable to a savings account with the full state and local tax exemption applied to all earned yield. From Step 1 to Step 3, the final instrument in this framework is TreasuryDirect.gov itself, direct auction purchase of 3-month or 6-month Treasury bills at the full government yield with zero intermediary margin, zero expense ratio, and direct ownership of U.S. government obligations with no institutional layer between you and the asset. Now address the objection that appears in virtually every comment section, every forum thread, every conversation about moving savings out of FDIC-insured accounts. The FDIC insures your deposit up to $250,000 per depositor per institution. This is a real protection mechanism. But track the organizational architecture carefully. The FDIC is a U.S. government agency. Its insurance guarantee is backed by the full faith and credit of the United States government. A direct Treasury security is an obligation of the same U.S. government that backs the FDIC. You are not moving from a government-guaranteed instrument to an unguaranteed one. You are moving from a government-guaranteed instrument held through a private bank intermediary to a government obligation held directly, without the private bank intermediary extracting a spread. The organizational chart resolves the objection. The risk comparison that inverts the FDIC argument is this: Treasury is the government that backs the FDIC. Holding Treasury securities directly eliminates the intermediary layer while preserving direct exposure to the same sovereign creditworthiness that underwrites the insurance you were relying on at the bank. And there are now $6.8 trillion in U.S. money market fund assets, per Investment Company Institute data as of 2025, deployed by institutional and retail investors who have already moved through exactly this analysis. The complete decision framework operates as follows. Your operational checking account remains at your bank. This analysis has never suggested otherwise. The banking infrastructure for payment processing, bill automation, and day-to-day transaction mechanics has genuine utility. What this framework addresses is idle capital, the savings balance earning a bank's marginal deposit rate while the bank deploys the same dollar at multiples of that rate. For any balance maintained as an emergency reserve of 3 to 6 months of expenses, a Treasury-only money market fund or SGOV provides comparable liquidity with T+1 settlement and the complete state and local tax exemption. For any balance maintained beyond the emergency reserve, capital held for a defined future purpose over a 3 to 12-month horizon, direct Treasury bill purchase through Treasury Direct or a brokerage account provides the full government yield with no intermediary spread and the full statutory tax advantage. The implementation is a brokerage account you likely already have, a CUSIP search for the current 3-month Treasury bill auction, and a purchase order. Or a ticker symbol, SGOV, entered into the same interface you currently use for any other investment. The 3-level awareness hierarchy ends here. The first level of awareness holds that traditional savings accounts pay poorly and the bank keeps the spread. Most financially literate Americans have reached this understanding. The second level of awareness holds that high-yield savings accounts represent the optimized solution. This is where the majority of financially sophisticated Americans currently reside, and where the banking industry's promotional infrastructure is designed to keep them. The third level of awareness, the level this analysis has just delivered, holds that the high-yield savings account is a better seat in the same machine. That the complete tax architecture changes the yield comparison in ways the bank never calculates for you. That the instrument the bank uses to generate returns from your deposit is an instrument you can own directly. That the middleman position the bank occupies between your capital and U.S. Treasury securities exists only because you have not yet taken the 30 minutes required to eliminate it. The bank's entire business model in this segment depends on you never asking one question. Can I do this myself? The answer has always been yes. And now you know exactly how. The single executable step is this: open TreasuryDirect.gov or your existing brokerage account today. Search the current 3-month Treasury bill yield. Compare it to your current savings rate on an after-tax basis using your state's marginal income tax rate. Then make a decision with the complete picture in front of you, not the picture the bank chose to show you. Understanding this single layer of the system will not protect everything you have built. There are compounding structural vulnerabilities in the broader personal finance architecture: tax drag, sequence of returns risk, the silent erosion of purchasing power across asset classes, that operate on the same invisible principle as the bank spread. The analysis of those mechanisms is the next framework. Every vulnerability your savings faces that you have not yet been shown lives in that direction. The question is how many of them your current strategy has already been exposed to.